Imagine your father handed you a $100 bill in the year 2000. He saved it, you waited. Today, that same $100 buys you about 57 cents on every dollar he saved. The bill is the same. The math is not. He didn't lose it to a bad trade. He didn't lose it to a bad bank. He didn't even spend it. He held cash. And while he slept, the money quietly rotted in his pocket. Taxed by something nobody calls a tax, paid to nobody who will ever send him a receipt. To understand what just happened to your father's $100, look at what's happening right now. In March of 2026, the Bureau of Labor Statistics reported headline inflation running at 3.3% year over year. Core inflation, stripping out food and energy, at 2.6%, above the Federal Reserve's 2% target, as it has been every single year since 2021. Cumulatively, the U.S. dollar has lost 22.7% of its purchasing power since January 2020. In 6 years, the headline rate sounds small, the cumulative number does not. And underneath both, the Fed's balance sheet sits at $7 trillion, well above the $4 trillion it carried before 2020. M2, the broad money supply-wise, sits near $22 trillion, up 42% from its pre-pandemic level. This is the modern American monetary balance sheet in its quiet, uneventful state. And at the center of it is a financial behavior so common nobody questions it anymore: holding cash. On paper, holding cash makes sense. The standard arguments line up cleanly. The liquidity argument: I need access on short notice, emergencies, opportunities, monthly bills. Cash gives me that. The classic rule says 3 to 6 months of essential expenses should sit in cash. The capital preservation argument: cash can't go down in nominal value. Stocks crash, houses go underwater, cash just stays. This is psychologically compelling because it's what your bank statement reports. Nominal balance never adjusted for what those dollars can actually buy. The optionality argument: if markets crash, I want dry powder to buy at discounts. Valid for a small tactical sleeve. Loses force as a default for the entire balance sheet because the right time to deploy almost never arrives, and meanwhile, the cash compounds losses. The simplicity argument: I don't know what else to do with it. Figuring out alternatives takes work. Most American households save in checking accounts paying near 0% interest because the friction of moving the money somewhere else is real. And the trust argument: stocks are too volatile. Real estate is too illiquid. Crypto is speculative. Cash is the only thing I trust. Each argument is internally coherent. The thesis isn't categorically wrong. The first 3 to 6 months of expenses parked in cash are arguably the highest utility dollars on a household balance sheet. What this episode is about is everything beyond that layer: the multi-year cash hoard, the savings sitting in a checking account for years, the fixed nominal income that doesn't reprice, the conservative portfolio, 30% cash sleeve, someone parked there in 2018 and forgot. That's where the bull thesis quietly fails. Not because cash is bad, because cash isn't actually neutral. Picture the trade as it actually happens. It's the first of the month. Paycheck hits the checking account. The account is paying around 0.6%. Inflation last year was 3.3. The math is already running against the saver before they've made a single decision. They don't move it. They could move it into a money market fund paying 4%, into treasury bills paying 4.1, into a balanced portfolio paying somewhere between 5 and 7 on average. They don't. 2 weeks pass, bills get paid, balance drifts up. End of the year, $20,000 sitting in checking. They didn't choose to lose money. They chose not to choose. And cumulatively, over 6 years, the saver who held that $20,000 baseline in cash has watched it become worth, in real purchasing power, about $16,300. That's almost $4,000 of purchasing power. Gone. No statement showed it. No broker called. No regulator opened a case. The money is still there in nominal terms. The $100 bills are still $100 bills. What changed is what they buy. Most people picture inflation like this. Prices go up because shopkeepers want more profit, or because supply chains are tight, or because workers demand higher wages. Sometimes those things matter. Underneath them, there's a different mechanism. Older, quieter, stronger. Milton Friedman put it in 8 words in 1963. Inflation is always and everywhere a monetary phenomenon. Translation: when the money supply grows faster than goods and services, each dollar buys less. Between February 2020 and July 2022, U.S. money supply went from $15.5 trillion to $22 trillion, 42% expansion in 28 months. But new money doesn't enter the economy evenly. It enters at one specific point: central bank asset purchases, treasury auctions, large bank reserves. The first recipients spend the new money before prices catch up. They get the temporarily higher purchasing power. An Irish-born banker named Richard Cantillon, described it in an essay published in 1755. New gold mine. The mine owner gets the new gold first. Spends on luxury goods. Their prices rise. The shopkeeper at the end of the chain receives the same nominal dollars, but those dollars buy less. Modern economists call it the Cantillon effect. It is the structural reason inflation transfers wealth, in a sequence that benefits the financial system first and the people earning wages last. This episode is sponsored by my own private community. If a story like this made you look at your own balance sheet differently, this is built for that. A private community where I break down over 100,000 deep dive courses on investing, finance, and the cognition behind decisions that quietly cost people decades. Most of this doesn't fit one episode. It fits the inside. Link is in the description below. All right, back to the story. Once you understand how new money enters the system, the rest of the story is about who pays for it. A saver puts $10,000 in a checking account in January 2020. 6 years later, the nominal balance hasn't changed. Still $10,000, but cumulative inflation over those 6 years was 22.7%. The real purchasing power of that $10,000 dropped to about $8,150, almost $2,000 gone. No statement showed it. No regulator filed a case. They held cash. Now zoom out. The same arithmetic applies across the U.S. household balance sheet. Cash holders lose. Debtors win. The federal government, the largest debtor in the world, saw the real burden of its $34 trillion of public debt cut by trillions. Without a vote, without legislation, without a name attached to the policy. This isn't new. It's how the United States got out of World War II debt. In 1946, U.S. public debt sat at 106% of GDP. By 1974, we're 23%. Some of that came from growth. A lot of it came from inflation eroding the real burden, while the Federal Reserve pegged interest rates below inflation. From 1942 through 1951, explicit policy for 9 years, holders of long-term Treasury bonds, the most conservative, patriotic savers in America, earned negative real returns, so the federal government could quietly retire its war debt at their expense. Monetary economists have a name for this. They call it financial repression. In the post-war decades, it cut U.S. debt by 30 to 40 percentage points of GDP per decade. Same mechanism, different decade. Once you see the mechanism in full, the system stops looking like a market malfunction. It starts looking like a feature. Inflation is not a bug. When sustained at 2 to 3% a year, it is a wealth transfer machine with 3 primary beneficiaries. The government, which is the largest debtor, its real debt erodes silently, no vote required. Asset holders whose stocks, Real estate and commodities reprice faster than wages or fixed income payments. And debtors with fixed rate liabilities, mortgage holders, student loan holders, anyone who owes nominal dollars while earning more nominal dollars over time. The losers are the mirror image: cash savers, long-duration bondholders, wage earners whose paychecks lag inflation, retirees on fixed nominal income. The system runs because three things compound. The political incentive runs toward mild, persistent inflation. The government always benefits. Voters punish recessions more than slow erosion. Central banks plan a 2% inflation target, meaning they treat steady cash holder erosion as a feature, not a bug. And the behavioral default, holding cash, is sticky, which makes the wealth transfer durable. Compare that to where holding cash genuinely works. The first 3 to 6 months of expenses parked for liquidity, a planned big purchase in the next 12 months, a short window job transition reserve, an evacuation phase from a hyperinflation. In all those cases, the time horizon is short and the optionality value beats the inflation cost. What changes everything is when cash becomes the default for years, not months. That's where it stops being a savings tool and starts being a transfer. 3 rules to take from this. Rule 1. Treat cash as a liquidity tool, not a savings tool. The first 3 to 6 months of essential expenses belong in cash. Anything beyond that, sitting at 0 or near 0 interest for more than 12 months, is paying a hidden tax to whoever issued your monthly statement. Rule 2. The Fed targets 2% inflation, not 0. Plan for it. Any nominal yield below the Fed's target is, by definition, a real loss in slow motion. A 4% CD doesn't give you a 4% return. It gives you what's left after inflation takes its share. Rule 3, read your real wage growth, not your raise. Your raise is what the company is willing to call you. Your real wage growth is what your paycheck buys at the grocery store. From January 2021 to mid-2025, the average American got a 22% raise and lost almost 1% in real purchasing power. The company is not lying. The numbers tell 2 different stories. Both are true. These are operational rules, not philosophical ones. They are what's left after you remove the friendly bank statement and look at what those dollars actually buy. Picture the same $100 bill from the year 2000. 6 years later, your father's $100 buys roughly 57 cents on every dollar he saved. 6 years from now, it'll buy about half. 6 years after that, less than half. The bill is still the bill. The math will keep moving. The institutions telling you to save more are the same ones running the printer. Both pieces of advice are sincere. The math is rigged both at once. If you want more breakdowns like this, subscribe. There's a lot of math worth understanding. Numbers don't lie, but they don't explain themselves either.